Welcome to a brand new property debate show that will reveal the truth in buying and selling. People from across the country have got in touch to ask the questions we all want answers to, from gazumping to valuing and investments to regional fluctuations. Nothing is off limits. I'm Sarah Walker, and joining me today is an expert panel from the global property consultancy Knight Frank. Now, in partnership with The Telegraph, they've bravely put themselves on the front line and agreed to answer your questions honestly. So, joining me from Knight Frank, we have Simon Gammon. He's the managing partner of Knight Frank Finance. Tim Hyatt is head of lettings. We're also joined by James Pace, head of sales for Chelsea and South Kensington. Nick Loth is head of sales in Berkshire, and Gronya Gilmore is head of UK residential research. The Homeowners Alliance says fees can be anywhere between 0.75% and 3.5% of the agreed selling price. Why such a variation?
There are two main reasons. The first is the type of agency that you employ your agents on, and the second is competition. You can employ agents in three different ways. The first being on a sole agency basis, second on a joint sole agency basis where you have two agents working together, and the third on a multiple basis. The difference in fee will apply to each type of agency. And then, of course, it's competition as well. Some agents will desperately want your instructions, so they'll be prepared to negotiate fees harder.
So is that an indication, you say, because of competition? Is that indication of the better estate agents to the not so good estate agents?
Quite possibly, yes. And it'll also depend, I think, on the type of service that you're given by your agent. Some agents will be prepared to invest quite a lot of not only time and money and expertise, but also money into the presentation of your property. And other agents will just be listing your property on a website, so it'll cost them nothing.
Nick, I'd like to bring you in here because a lot of people want to know, are these fees actually justified?
That will depend entirely on the agent that you use and the quality of that agent. I think a good agent is worth its fees.
Are your fees justified?
I would say they are, in terms of what I can deliver for my client and the level of service we give them, and more importantly in the day, the fee, the income we provide them from selling their house properly. Always be aware of the agent that comes along and quotes you the lowest fee and the highest valuation. There's probably a reason why they're doing it, and that's to buy your business. And in the long term, you'll be poorer off for it.
A lot of people believe that fees are in fact negotiable. Is that correct? Are yours negotiable?
Yes, they are negotiable to a point. A good agent should be a quality agent, and you get what you pay for. But there is competition. Some of it is good and some of it is bad. So yes, there's always a degree of negotiation. But as I said, the cheapest agent is not necessarily the best agent. There
do seem to be a number of hidden costs, and what we're hearing from people is they want to know, are these the agent or the solicitor side? Where do they come from?
On the letting side, there's an ASA ruling last year on the tenant side that before a tenant even got in the car to come and see a property, the agent has to declare the fees that they might be charged. So we have an administration fee, there is a referencing fee for taking credit scores. A tenant has a right, and there is a ruling now that they have to see those fees before they come to see us.
Which plays into the whole transparency.
Right across the board, which plays to the transparency of it all.
Okay, so you guys feel that your fees are justified, some slightly negotiable, but when you're looking at fees, it's down to what you'll get in return, basically.
Very much so.
What does an estate agent look for when it's valuing a property?
The old cliche, location, location, location. Is it in a good catchment? Is it good for communications? Does it have curb appeal? Is it a pretty house? There can be a number of things that one will look for.
You might argue the majority of the time that vendors know how much their house is worth. But one of the questions is, why then do some estate agents overvalue a property, which subsequently, I suppose, creates greed from the vendor and can, I suppose, result in no sale?
Overpricing is a typical cheap agent trick, in my humble opinion, where they're simply trying to buy your business. It's like an obvious thing to say, but remember, it's not the agent that's paying that price. So if they're giving you a high figure, if it's higher than everyone else, ask for the evidence. Where's the justification of that? Where's the comparable evidence to say why they feel that figure is 10 or 20% higher? If not, be very suspicious of it.
And in terms of lettings?
Yeah, I mean, I think it's down to supply and demand as well. If there's a lot of demand and not a lot of supply, then obviously overvaluing is going to happen. But it's not going to be called overvaluing. It's just going to be relative to what the market is there. I think also when, picking up from what Nick said, you look at what's going on in the local area, but from a tenant's perspective, they want to know what they're going to get for their rent. You know, they're paying money that's been dispersed. Are they going to have a gym? They'll pay a small premium for it. Are they going to have a car parking space because there's no on-street car parking? They'll pay a slight premium for it. Are there social amenities within the block that they can use? They'll pay a slight premium for that. And you have to factor all of that in when you're valuing it. To a degree, it's a science. I think we would all agree with that. Agents don't necessarily always get it right. Nick agree, and I totally agree with them. They do.
Do you not always get it right?
What we have to do is we have to put ourselves in a buyer's or a tenant's shoes and estimate what somebody's going to pay for it. So it's a subjective view. You can't get it absolutely right. It's not like the commercial world where you have everything done on a pound per square foot basis.
You talked about supply and demand. You said the price, well, we've seen surveys say prices are expected to rise by around 2% annually in Wales, 9.3% a year in London. I mean, are we about to see another bubble? Where do we feel we are in terms of that? I'm not sure who would like to pick that. Grania?
Well, we're in a highly regionalised market, as you say, 2% a year in Wales. That's hardly keeping up with inflation. Whereas in London, we're seeing prices going ahead. It does come back down to this supply and demand issue, and I'm sure you would agree with me, James. You can see the power of equity in the market in London at the moment. So people are coming in and buying, but the transactions of people who would normally be selling to buy is not happening. People are staying put. So we've seen that, and the sheer demand for property with a lack of supply means that prices are being pushed up. The level of growth we're seeing at the moment, just the sheer pace of it, I can't see that being sustained. The pace of growth may tail off in the years to come.
I think outside of London, it's a very different world to within London, and I think it is a different world. We are not seeing a bubble in the country. I don't believe, certainly in Berkshire. We are seeing a return of confidence, and prices are going to start edging up. But a bubble, no, I hope that's not famous last words.
Outside London, we've got to remember that the housing market has really done very little for maybe 4 or 5 years. Transactions have been so low and prices really haven't travelled. In real terms, actually, outside London, we have some areas where prices are maybe over 40% lower than they were at the previous peak of the market. So I think in terms of bubble territory, we're very far from that.
Yeah, I would agree. Bubbles burst. And I can't see it being a spectacular burst at the moment. I think interest rates will have an impact, and they are inevitably going to go up. I think Simon will answer it better, but it's not likely to be for at least a year or so, probably into 2015-16. But I think we've got to remember we're in a pretty good economic state. London is flying. It's one of the leading capital cities in the world. The sentiment of people wanting to invest in London is still very strong. So I think we're in a positive place. There might be a slight dampener in terms of the election, but that will just slow things down a bit. It's certainly not going to burst the bubble.
The talk is late 2015, we will see rates start to go up. What will that impact then be?
Well, clearly, if you're borrowing, you have a mortgage, it's going to see for a lot of you, a lot of people, an increase in their monthly payments. I think it will be the second half of 2015 after the election. A lot of commentators say spring 2015. But no one's really saying anything other than rates will go up. It's important to be looking at your finances now to prepare for that. If you do have a mortgage, you should be looking at whether you should be fixing that mortgage. When interest rates do go up, I believe they will probably only go up by 0.25% by the first time, and the Bank of England will watch everyone with great interest and see whether or not the economy copes. The economy will cope, it will be fine, but it will be a shock to everyone after by then 6 years' time. The base rate's been at 0.5%. When it goes up by 0.25%, as I expect, I think we will then see another rise relatively shortly after that, as everyone gets used to the idea that the base rate may be returning to normal levels.
As Simon says, the key question is going to be how quickly rates start to rise. I think we're still concerned when they're going to start to rise. Actually, the key question is once they start, how quickly will it be? I think one thing just to bear in mind is that interest rates at the moment, a lot of people are borrowing at 2.5%. And it only takes the mortgage rate to go to 4 or 5% for your monthly payments to double. That's a massive change, and a lot of people wouldn't be able to cope with that.
Especially when it comes to the letting side.
Yeah, and I mean, that will probably drive, make it harder for you to get onto the property ladder once those interest rates start to tick up, because it will become less affordable to take a mortgage. Yes, the banks might be more generous and lending a little bit more by then, but I can only see the private rented sector increasing as a result of interest rates rising as well.
Breaking away from being an owner-occupier, if you're a property investor, then things are going to move more into your favour. Your voids are going to come down, your yields are probably going to go up, your capital return, your total return might freeze a little bit, but When things slow down for sales, it tends to move naturally into lettings.
But again, it comes down to making sure you're prepared, making sure you don't overextend yourself, you do your research, and hoping that the mortgage broker, the estate agents are transparent.